U.S. election behind us. Our guest today saying it's back to business for the markets. Joining us now with more on that is Brad Simpson, Chief Wealth Strategist with TD Wealth. Brad, always great to have you on the show. What a week. The dust is settling. We know who's going to take the White House. We know the Senate. We're, a few other details to iron out. But you're saying it's time to move beyond.
Yeah, boy, what an unbelievable week. And I guess we'll start with thanks so much for having me. And I think that one of the things that we've been talking a lot about over the last 36 hours is this idea of back to business. And that so much of the discussion and much of the way the markets have been moving over the last few months is been on sentiment and this idea of what's going to happen with the election and both on the outcomes for the economy and markets, but also in the geopolitical stance as well. And so of course so much of that means that in the short-term market was really started to get driven by sentiment. And at the end of the day, we're investors, and sentiment isn't something that you really want to sink your teeth into. What you want really is ultimately is to talk about the economy, and then talk about what companies are doing in that, and what debt markets look like. So I guess I'm pretty happy to say, goodbye to the pundits and the attack ads and all the mudslinging, and also good riddance to betting markets and this political sentiment that's been driving the markets. And it's time to get back to thinking about business and what that means for building and managing investment portfolios.
All right, so let's do that. You put out a report where you talk about getting back into business. Start walking us through some of the ideas that we should be thinking about. We got 2 months left in this year, less than 2 months. Obviously, 2025 will come with a new administration in Washington.
Right.
But when we put it all together, where should our heads be at?
Well, I think the starting point is that I think we got to, I think we have to do a bit of a postmortem on the election and think about what a new Trump administration means, because that is going to have an impact on the economy, and that is going to have a really large impact on where we think markets are going to go from here. And one of the things that was a constant in this election was this discussion around the economy and the U.S. economy, and is it healthy or not? And it was remarkable, right? On the one side, if you listened to the Democratic side, this was a really healthy economy, and if you listen to the Republican side, that it was a rather unhealthy one. And so, I think you have to figure that out, because that's going to be the big part of the driver of as we go forward. And so, when you do look at the U.S. economy, and we think that's the most important economy to look at right now, because it is the driver. It really is the driver of the global economy right now, and the driver of equity markets and debt markets as well. And so when you look at that, you go, well, inflation is normalized, unemployment is around 4%, manufacturing is headed in the right direction, while it's sitting at around you look at the ISM index around 46. That's below the desired 50 mark, but it is improving. When we look at the non-manufacturing index that actually came out this week, was at 56, above from the 54.9 where we were a month ago, and this was also above expectations. And then we look over at the consumer, and they're really as healthy as well. And you got to stop for a little bit and say, well, what gives? And I think the interesting thing to make that we're looking at the market is I brought a chart along which I thought would add a lot of context to this, and what we're showing, if we can beam it up there, is that this is the world through the consumer lens and the American consumer lens, but from a market perspective. And if you look at it, what we're looking at here is the performance of Hermes International and Ferrari, and comparing that going back versus Dollar General and Dollar Tree. And boy, you can tell that if you wanted to see through a market perspective of the election as a whole, you're staring at it. and for the reality is, the last few years, if you were in the top percent of income earners in the United States, it's been a really terrific economy. And that, low with interest rates going down and financial assets, and particularly equity markets, is their balance sheet, their own personal balance sheets are in much better perspective. And, the purchasing power to go out and purchase yourself a new Ferrari is a pretty good deal. I watched a program one day that you could go out and purchase a new Bentley, and that isn't enough. You can actually ask them to paint the ceiling custom for you, so you can add a little bit more to it. And that's usually indicative of a consumer that's getting too extravagant.
Yeah, now you look on the other, money to burn.
Right, exactly. Now we look on the other side here is that if you were in the lower half of income earners in the United States, the inflation and higher interest rates have been very, very painful, and these folks, I think, en masse, really spoke in this election and just came out and said, this is the bottom line for us. And so, for us, I think the reason for that is as important is we often get this question of, because there was so much going on with this election about the discussion around, well, is the economy in the U.S. good or bad? It's really quite good. There is a large segment of the population there that the medicine that was given by central banks to curb inflation was very painful. And, and I don't want to detract from that anyways. It was painful. And the long story short, though, is that over the long term, and even over the interterm, it was critical to get inflation under control. And now that it is in a much better place, that the group in this kind of income level here are set up for a much better place as we move forward. And, irrespective of whoever won this election, is the bottom line is for the U.S. economy, it instead of slowing, like being late stage, which is kind of where it is, but moving towards a recession, what we really see is the U.S. economy kind of working its way around the corner and starting back up again. And if you look at the activity of what's happened in equity markets in the last 48 hours, it isn't just an acknowledgement of the Republicans coming in. It's actually just an acknowledgement that says the U.S. economy is in very good shape. The equity market is set up quite well to be able to participate in that. And that, the biggest concern, and one of the things that we wrote about in our portfolio strategy quarterly, and you and I've talked about in the past, one of the things that we were really worried about in this election was what happens in that interterm period. What happens if this is a close election? And what if we have this, it's disputed, much like we saw last time, or if you recall back in the early 2000s, the Gore-Bush election, where you weren't sure who the winner was, and then that leads to transfer of power, which we were worried that could lead to heightened volatility. Well, with this decisive victory from the Republican Party, that concern is out of the marketplace. That risk is gone. And what markets like is certainty. Ambiguity markets hate. What they do like is certainty. And what is certain now is that this was a decisive victory. We're not going to have any constitutional crises here. And that the market reaction, I would say, is you take that plus a healthy economy, and it sets up for a pretty good equity market here.
So let's talk about the longer term. Obviously, some dramatic moves yesterday. We saw the money-centered banks do quite well. But longer term, you always talk about the importance of diversification.
Yeah, no, and I think that's for sure. So if we think about diversification, let's just look at what this new administration works. So I brought a chart along to be able to consider that, where we look at the impact we think it's going to have. So let's start with the equity market, and I guess you can see from my opening comments here is that whether you have a Republican sweep or a divided Senate House, clearly to me it's pretty clear that it's going to be a Republican sweep at the end of the day. But on either case of that for the U.S. market, it's a real positive and I think I went through that pretty well there. bond yields, we're talking about interest rates being higher, and so for that means that capital gains from fixed income markets are going to be harder to come by, but you're also going to be looking at a pretty good yield. And the reason for that is the yield curve steepening, meaning that you have short-term rates, and the difference between a short-term rate, 10-year treasuries today is sitting at around 4.5%, which is a significant move, and it shows kind of that concern here. When we look at the sectors that we think are going to benefit from this, cyclicals like we saw going even into this election, financials, industrials, energy, and lo and behold, crypto, which we think is positive. Sectors that we think are going to underperform would be clean tech and companies that are exposed to tariff risks, high dependency in particular on imported goods. And factors may well perform well is small cap as well. And I think that's a good way of at least looking at what the impact is of this new administration.
And as we look at it even further than that, I mean, once we get to January, get a new administration, then we have 4 years. For the long-term investor, we've often talked on the program with you about stay in the course, having a strategy, figuring out how the world has changed, then build a strategy around that and stick to a strategy.
Right. That I think one of the things that for us over the recent weeks and the outcome of this election has been incredibly gratifying is, we obviously very deeply believe in the importance of having a diversified investment portfolio. And I think one of the things that I think that non-professional investors often do is they make these big shifts between what they do. And when they work, it's a really great swing, but when it doesn't, it's really quite painful. And for us, like investment success really comes down to your thinking process and how you're going to be able to allocate. And so if we look here, that we're going into the election, we published our portfolio strategy quarterly, and this was about a week and a half ago, and in that we said, look, for the year ahead that we're looking at and based on our process of what we're doing, we actually made quite a few changes. And the first one was we said we like fixed income, but particularly for the yield. But because of both political parties are talking about increasing the deficits, we think that has a potential headwind for yield. So we went underweight fixed income. We went overweight equity at the same time, and we did that based on the idea that once the dust had settled and the kind of the clarity of us around whoever the winner was going to be, the equity markets were going to be quite strong because of the long-term economic outlook, which is pretty good. Like when you look at GDP growth, employment again, and the strength of consumer, inflation, and corporate earnings and rates, it's a very good story that is out there. And so for us, when we look at the way that we're allocated right now, is that the key to this is that on all accounts, that the way we positioned for the immediate worked out very well for us. But the way we're positioned going forward over the next 12 to 18 months, I think that's a really good structure for us to have right now. And I think it's something to think about.